That would blow those.
So what do you think the government wants to happen with those?
They're gone.
Yeah. So, so what it comes down to is you've got all these charges that we add in and we're used to seeing, and now we're going to include them in the 3%. And it just becomes too much. You've got a cookie jar, but you can only fit so much in. And everybody's got to get paid. And you don't get paid until that loan goes through. And you got to get the loan officer running. The whole reason we're here today is this one right here. 12 CFR 1026-32 is the exception to the exception, really to the exception. So if we were to go back to remember, so if there's a charge that is not related or if it's reasonable. Now when they say reasonable, if the charge is reasonable, they consider that to be anything that's an arm's length transaction. So if you do actually go find a third-party appraiser, and you pay $450 for an appraiser to appraise the house, and $450 is the going rate in the area, that's reasonable. It's not going to anybody that's affiliated, it won't be included. Okay? $800 for it, because your loan originator has a buddy who's doing it, and his buddy has got really hard. Because he's just got divorced, he's got child support, alimony, so he's doubling it, you don't know this. But now he has to include it, and it just killed your deal, right? So you got to stay away from people who are going to do that. And then it'd be nice to work with someone who has the ability to do this. The creditor paid charge exception under 12 CFR is when your lender has a fee that he can charge you, but he says, I'm not going to, and he waives it. If the lender waives it, it doesn't get included. How many can do that, though? Very few mortgage brokers can waive it, especially now. They don't have a lot of room. And so that's where a company like Home Funding Corp comes in. Now, John will talk to you a little bit about how they have reacted to this, because they started reacting long before this rule came in. I got a call from John when the low comp rule came in. And because there are some things that could have been done by some of these lenders under the LO comp rule to help them with 3% consideration that will lower the percentage that they're calculating within that 3%, so they're not having to worry about it so much. And then there's some things you can do there.
Thanks, Mike. Like Mike said, there's a lot of things that are changing, and I think a lot of people are not even aware of the changes that are occurring. Me and Mike and a few others did a presentation in our Las Vegas office last Thursday, and we had, I think we had about 40, 50 realtors, and when we started talking about this, they were not aware that anything like this was even happening. I think a lot of people in that industry are hoping that when January the 10th comes around, that either Congress is going to change their minds or they're going to prolong it, like they've been doing with Obamacare. But what we have seen is that they're not going to prolong it because we are already getting letters and emails from some of our investors we sell loans to, and they're telling us that if the loan doesn't meet the criteria, they will not buy. Okay? So a lot of companies are taking a long time to prepare. Like Mike said, we started this process earlier this year, way earlier this year. And that's why I even asked Mike to come and do a presentation here from Las Vegas. He just flew in. Because I think it's important, because a lot of the times, you know, the realtors are not aware of what's going on, and then all of a sudden next year you get your loan officer calls you and says, well, I can't do the loan. Well, what do you mean you can't do the loan? Well, the debt ratio is this and this, and the debt ratio is 44%. The guy has high FICO scores, I can't do it. Well, you guys know, you guys are probably the seasoned veterans, you guys would know that that's not a bad debt ratio even today's times. You're going to say, what are you talking about? And a lot of people have not been very proactive, like we have been very proactive. The Frank Dodd, when it was enacted, first it was enacted to go out to the loan officers. The loan officers, basically, they said, you can either get paid by a borrower, if they're going to pay points, or you can get paid as a rebate. You can't get both. Okay? Okay, fine. Okay, now they come out with more of the restrictions, where now the 3-point rule came in. The 3-point rule covers a variety of things. A lot of people were not certain what it doesn't cover, but we know the things it does cover, such as, and like Mike said, if it goes to an affiliate, if right now if you're working with Century 21, if you have your mortgage company, any transaction that they pay to those realtor, whether it's transaction fee to your processor or loan coordinator, it's part of the fee now. Okay? If a borrower has mortgage insurance, okay, portion of that mortgage insurance, it's not refundable, it's part of the 3 points. If somebody has an impound account, the taxes are not part of the 3 points, but the insurance is. Okay?
A house insurance.
House insurance, if it's impounded. Okay? Now, seller pays, what does it say? You want to buy down the rate. So the seller pays 1 point to pay for the loan officer's portion of it. If he does that, it's on a purchase transaction, now that's part of the 3 points. Okay? So it's going to be very tough, and it's just a matter of how we come together as a group. Like, I always look at the realtors and loan officers, we're a team. Without each other, we can't conduct business. Okay? So that's why it's important the people that we do business with, the real estate companies that we are direct lenders with, or we sit in their offices, we have already sat down with them and says, okay, this is how we're going to tackle this situation. Okay? Like Mike said, well, some of the people are not going to the fees. Well, the fees they're not going to reduce. First of all, if you're doing business with a broker, he has no control over the fees because he's going to tell the wholesale lender, hey, can you cut the fees? They're going to say, sure thing. They're not. Okay? And if they do, as industry standard, what are they going to do? They can't just cut fees on one transaction. If they're a bigger organization like BOA and things like that, they're going to have to make it straight across the board because now they're going to say they're discriminating if they do once in a while. Okay? So there's the good and bad why working with bigger companies and working with smaller companies. I did a presentation of Palm Springs, a real estate company, and the first thing one of the realtors asked me says, are we going to have to beg you to cut the fees? No, you're not going to have to beg me. But if it's going to make the deal work, we're going to make sure it's going to work. Okay? Mike said about the debt ratio. The debt ratio right now, if we run an automated underwriting system, it would go to 50%. Okay? Okay. Right as of January the 10th, the max is going to go to is 43%. That's on conventional loans. FHA, we could go to still 56. But guess what? We just lowered the limits on FHAs. Now we got $350,000 versus $500,000. Okay? FHA has their own set of QM rules, but the 3-point rule is still in there. Okay? So it's not going away. The 3-point rule is still going to be there. Okay? The other thing that Mike also talked about is what type of loan. The QM versus I believe he says the higher priced ones. Right now, there was a survey done about 3 months ago out of a company out of San Francisco. They said that the QM and ATR rule were in place right now. 1 out of 5 people would not qualify for a loan. I have the funds right. 1 out of 5. Okay? It's a lot. Okay? Now, they did not take into consideration all the overlays that the investors and lenders are going to also place. We had a loan officer that just came to us from Wells Fargo. He showed me a loan. The FICO score was 686. The debt ratio was 39.96. Had an automated underwriting system approval, and they turned it down. Okay? They are setting, like Mike says, there's more of a liability for them, so they're not going to take chances. Okay? They're going to be very restrictive about what type of loans they're going to be doing. Because they really don't need to do it. Okay? If you're doing servicing how many trillions of loans, you don't have to cut the corners and having a lawsuit, because they're open to lawsuits, because they're going to, I'm sure an army of real estate lawyers like Mike is going to be on force next year, and they're going to be. The sad part about the ATR is that the borrower can claim. Depends on what type of transaction it is, but the borrower could claim that he was never pre-qualified correctly, and then since he's going to foreclosure, he's gonna sue.